Welcome back to Investing Talk Podcast. Today, we are taking a fascinating, really in-depth look at a company called Priority Technology Holdings. It's right there in the middle of the whole digital payments revolution. And we're tackling that big question that's probably on a lot of your minds. Is now actually a good time to think about buying its stock? Our mission today is pretty straightforward. Break down the key aspects of this company, its finances, market position, what the future might hold. The goal is so that you, our listener, can walk away with a really clear understanding of its potential and, just as importantly, the challenges it faces. Before we really get started, if you find this conversation valuable, please do take a moment to subscribe, like, and maybe leave a comment. It genuinely helps us bring more analyses like this to you. And hey, if you're feeling generous, you could even consider buying us a coffee. Oh, and one more thing, if there's a specific company you'd like us to look into next, just pop it in the comments below once we've introduced the topic. Okay, let's unpack the fundamentals of Priority Technology Holdings.
When we talk about a company's core health, what are the first numbers telling us? How's its business performance looking?
Well, looking right at the basics, Priority Technology Holdings definitely shows some robust revenue growth. That's the first thing that jumps out. Their trailing 12-month revenue that gives us a good picture of the last year, it stands pretty impressively at $918.56 million. And what's really compelling, I think, is the solid 16.4% year-over-year growth. That's from 2023 to 2024. Getting that kind of consistent double-digit growth, well, it suggests the company is really expanding its reach, increasing transaction volumes. Now, earnings for that same period, the trailing 12 months, came in at $20.87 million. That works out to an EPS earnings per share of $0.26. And that's, a key metric. Shows how much profit they're making for each share out there.
Okay, yeah, that revenue growth is eye-catching. Definitely hints they're grabbing more market share, expanding. But as you know, and as savvy investors know, growth without decent profitability can sometimes be a bit shaky, right? A house built on sand. So digging a bit deeper, how healthy is their actual profitability? What's the story there?
Right, and that's where we see a bit of a mixed picture. It's really crucial for you to understand this part. The gross margin is quite healthy, actually. It's 38.1%.
That sounds pretty good.
It is good, yeah. It shows they have a strong handle on the direct costs, the costs tied directly to providing their payment processing services. However, when we move down the income statement, the net profit margin is quite low, just 2.3%.
Wow, it's a big drop.
It is. And that steep drop from gross to net profit really highlights that their operational expenses, maybe aggressive marketing, maybe R&D, or maybe significant interest payments on debt, are pretty substantial. They're eating significantly into the profit they actually get to keep. But what's particularly fascinating here, though, is that despite that thin net margin, the company recently beat analyst EPS expectations. And they even provided positive earnings guidance for 2025. That usually signals some confidence for management,
That is a fascinating contrast. Strong revenue growth, good gross margins, but a tiny net profit. Tells us they're bringing money in the door, but a whole lot of it is going right back out before it hits the bottom line. So, okay, moving beyond just earnings for a second, what about their financial health from, say, a balance sheet perspective? Are there any hidden dangers or significant red flags we should be aware of, especially considering that potential high operational burn?
This raises an absolutely critical point about their balance sheet. And frankly, it's one of the most striking things about Priority Technology Holdings. The company has an extremely high debt-to-equity ratio. It's minus 639.2%.
Okay, unpack that. What does a negative number like that even mean?
Yeah, it's eye-popping, isn't it? It's not just a figure. It tells a story. It points to really aggressive growth, possibly fueled by massive borrowing, or maybe a history of significant losses that have just eaten away at shareholder equity over time. For you, the listener, what this really means is the company is leveraged right up to the hilt. Their liabilities vastly outstrip their assets. When equity goes negative, it literally means total liabilities are greater than total assets. Now, this can supercharge growth in the good times, right? It amplifies returns, but it leaves almost zero margin for error.
So very risky.
Extremely. Any market tremor, an economic slowdown, even just a slight dip in their earnings could become a potential earthquake for the company. It makes them incredibly vulnerable. Details on free cash flow are a bit limited in our sources, but high debt levels like this always raise huge concerns about liquidity, solvency, especially if earnings were to stumble or interest rates keep climbing. It's a real high-stakes gamble.
That paints a stark picture, definitely. A negative debt to equity like that is a major, major point for any potential investor to consider. So, given this backdrop, how does Priority Technology Holdings stack up in its industry? Is it like a big fish in a small pond, or is it swimming with sharks in a really competitive ocean?
Oh, it's definitely a competitive ocean. The payments technology industry is crowded, it's dynamic. They provide solutions for everyone from small and medium-sized businesses to complex B2B transactions, right up to large enterprise payments. Think about companies like Square or Fiserv or PayPal. Those are some of the giants swimming in these waters.
Right, huge players.
Exactly.
Yeah.
So Priority Technology Holdings tries to carve out its niche by focusing on its proprietary platform. That's meant to be a key competitive advantage. This platform lets them offer sort of differentiated services for independent sales organizations. Those are basically partners who resell or integrate Priority solutions, and also for various software vendors. What's surprising, though, is analysts actually rate them more favorably compared to their peers in the broader business services sector.
Really? Despite that debt?
Yeah, which suggests they see something compelling in its market strategy or maybe its growth path, even with that huge financial leverage hanging over it.
That is interesting. Favorable ratings despite that, frankly, daunting debt-to-equity ratio. What specific factors are analysts possibly seeing? Seems like they're maybe looking past the balance sheet to something else. Okay, give it all that. Let's shift gears a bit and talk valuation. What metrics should we be looking at to understand if the current stock price makes sense, relative to its earnings, sales, the company's actual value?
Exactly. Analysts are clearly pinning their hopes on future potential here. So when we look at the ratio analysis for valuation, Priority Technology Holdings has a trailing 12-month PE ratio of 31.8. Now, that's the price investors are paying right now for each dollar of their past year's earnings.
They pay 31.8?
A bit high, maybe?
You say it can seem that way?
Yeah.
But here's the kicker. Its forward PE, which looks at expected future earnings, is way lower. It's down at 10.8.
Ah, okay. That's a big difference.
No.
Huge difference. And that wide gap is a clear signal. Analysts are betting heavily, really heavily, on a dramatic acceleration in profitability and earnings in the coming year. Then you've got the PS ratio price to sales. That's around 0.71, based on its market cap and revenue. That indicates its market value is actually less than its annual sales. Sometimes that can suggest undervaluation, especially for a growth company like this. However, the PB ratio price to book, it's not really meaningful here, precisely because of that negative equity we talked about.
Right, the debt messes it up.
Completely. With liabilities exceeding assets, the book value is negative. It just distorts the metric, makes it totally unreliable for this specific company.
So that forward PE definitely stands out. It's like the analysts are saying, yeah, past earnings were okay, but just wait.
Mm-hmm.
How does that valuation, especially the expected future earnings, compare to competitors in this really fast-moving payment space? And what does it suggest about the potential upside for you, the investor?
Well, its current trailing PE of 31.8 is relatively high for the sector, yeah, meaning investors are paying a premium for its current earnings level. But, like we just said, if those forecast earnings actually happen, that forward PE of 10.8 could become much, much more attractive. It could make it look quite cheap relative to its expected growth.
So that's what the bulls are hanging their hats on.
Absolutely. From an analyst's perspective, this expected growth is the major driver behind their price targets. The mean or average price target for Priority Technology Holdings is $12.25. That suggests about a 45% upside from recent price levels. The highest target out there is pretty ambitious, $16. The lowest is $10. If you average those targets, it implies an impressive 54% potential upside if the company hit those marks.
Wow.
Yeah, this consensus really points to significant confidence from the analyst community in the company's ability to execute its growth strategy and, crucially, improve its profitability.
That is a powerful endorsement, signaling they think there's substantial room for the stock to run. But, okay, beyond the fundamentals and the valuations, what are the charts telling us? What's the stock's recent price action been like? What kind of story does that paint, maybe for traders or shorter-term investors?
The charts definitely add another layer, another dimension to the story here. The recent price range for Priority Technology Holdings has been pretty tight, actually, between $7.86 and $8.59, shows some consolidation in the immediate term. However, its 52-week range was much, much wider. It stretched from a low of $4.89 all the way up to a high of $12.47.
So it's been volatile.
Extremely. That wide range really illustrates the significant volatility the stock's seen over the past year. In terms of key technical levels, prices where buying or selling might pick up, we see pretty strong support down in the $7.80 to $8 area. That means it's a price floor where buyers have typically stepped in before, preventing further drops. On the upside, initial resistance where selling pressure might kick in looks to be around $9.50 to $10. And there's even stronger resistance closer to $12. Okay.
Breaking through those resistance levels, that would be a signal of renewed bullish momentum.
So it's had quite a ride over the last year, like you said, and we're currently in a bit of a tighter range now, but kind of flirting with those lower support levels. What's the overall trend been recently, and just how volatile is this stock compared to the broader market? Because, for investors who like a calm, steady climb, this might feel less like investing and more like a bit of a thrill ride.
You've hit the nail right on the head there. Priority Technology Holdings has recently been in a falling trend, actually. We're seeing negative technical signals indicating potential for more short-term weakness, which is consistent with it testing that support area we just mentioned. And its beta is 1.51.
Okay, what does beta 1.51 mean in plain English?
In plain English, it means this stock is significantly more volatile than the overall market. So if the S&P 500 moves 1%, you can generally expect Priority Technology Holdings to move about 1.51% in the same direction, both up and down.
Right. Amplified moves. Exactly. So yes, for investors looking for stability, this is definitely more of a thrill ride. While specific momentum indicators aren't detailed in our sources, the trend commentary does imply that maybe oversold conditions could be developing soon. Which, sometimes that can come before a bounce as the selling pressure just gets exhausted.
Okay, so we've got a stock that's seen strong revenue, yes, but thin, though, maybe improving margins. We've got that really daunting debt picture, but also strong analyst optimism and maybe a potential technical turning point near support. Let's turn now to recent news and the overall sentiment. What's been happening lately that could really impact the stock's path and how investors perceive it?
Yeah, the most notable recent news was definitely their Q2 2025 EPS beating analyst expectations. That was a significant positive surprise. Beating expectations often sends a strong signal to the market that the company is managing things effectively, maybe growing faster than people thought. This has certainly helped contribute to those robust analyst ratings we talked about. 4 analysts rate it strong buy. In total, there are 6 positive recommendations. That's 4 buy ratings and 2 strong buy ratings. Pretty solid consensus.
Definitely positive.
And we've also seen 1 analyst upgrade in just the last 90 days, which reinforces that generally constructive sentiment. What's more, our sources also indicate some support from social media. Now, that's not a fundamental driver, of course, but it can amplify sentiment and contribute to short-term price swings sometimes. So all this paints a picture of a company that seems to be gaining favor despite, its inherent complexities and that debt load.
Okay, so we've laid out the landscape, the good, the challenging, and that outright alarming debt picture. But for anyone looking at this stock, the crucial question is always, okay, what's next? What are the specific catalysts, the potential game changers that could really move the needle for Priority Technology Holdings, both, in the short run and maybe over the longer haul?
Sure. In the short term, that recent positive earnings report back in August 2025, that already drove sentiment quite a bit. The next reporting date, whenever that's set, could be another powerful catalyst. Investors will be watching really closely to see if they can keep up that positive earnings momentum.
Right. Proof of consistency.
Exactly. We'll also want to watch for a technical reversal on the charts, especially given the recent fall in price and the overall bullishness from analysts. If the stock can convincingly break out of its current falling trend, maybe clear some of those resistance levels we mentioned, that could attract more short-term buying interest. Long-term, the bigger picture trends are definitely working in their favor. The growing digital payment space, embedded finance, these are strong secular tailwinds.
Secular tailwinds, explain that quickly.
Oh, right. Secular tailwinds are just powerful long-term trends that tend to propel a whole industry forward, regardless of short-term economic ups and downs. So digital payments keep growing as cash use declines, and embedded finance integrating financial services directly into non-financial apps and platforms that's seen as a massive, still largely untapped market. These trends naturally help companies like Priority. Now, while there are no specific merger and acquisition rumors reported for Priority right now, the payment sector is very active in consolidation. So that could always become a factor down the line, either as them buying someone or being bought.
Always a possibility in tech.
Always. And of course, probably the biggest long-term positive would be any concrete steps, any initiatives to significantly reduce that high debt level. That would drastically improve their financial stability and lower the risk profile.
Okay, so there are definitely some strong potential upsides and trends working in their favor.
Okay.
But as we always stress, every investment comes with risks. We've talked about a lot of positives, but it's just as crucial, maybe more crucial, to understand what could go wrong. What are the key concerns for priority technology holdings that you, the investor, need to be really acutely aware of?
Yeah, absolutely critical. From an investment risk perspective, the number one most critical stock-specific risk is, without a doubt, their extremely high leverage. That truly astonishing net 639.2% debt-to-equity ratio exposes the company to considerable financial risk. It just does. If economic conditions worsen, if interest rates keep climbing, or if earnings were to falter for any reason, servicing that debt could become a huge, potentially crushing burden.
And the thin margins don't help there.
Exactly. Coupled right with that is their thin net profit margins, still only 2.3%, despite that strong revenue growth.
Yeah.
It shows that while they're growing the top line, they're not highly efficient yet at converting that revenue into actual profit. That makes them much more sensitive to any rise in costs or any dip in sales volume.
And what about broader risks? Things outside the company's direct control. Market shifts, sector pressures.
Good point. The payments technology industry, as we mentioned, is intensely competitive.
I keep coming back to that.
Because it's crucial. This intense competition from giants and nimble startups alike could really lead to margin compression over time. Companies are constantly fighting for market share, often by lowering fees or offering better terms, which can directly squeeze profitability for everyone. Furthermore, priority technology holdings is definitely susceptible to broader macroeconomic shifts. Things like overall commerce volumes. I mean, if consumers and businesses spend less, transaction volumes drop, hitting their revenue. Interest rates directly impact their cost of borrowing for all that debt. And credit market conditions affect both their ability to refinance that debt and the financial health of their small business clients. These external factors can all significantly impact their business, no matter how well they execute internally. So bringing it all together, looking at all the sources and data points, our analysis gives priority technology holdings an overall rating of 6.5 out of 10.
Okay, 6.5 out of 10.
Yeah, which indicates, a company with some notable strengths, for sure, but also pretty significant risk factors that really demand careful consideration.
So, considering that 6.5 rating and everything we've unpacked today, the growth, that massive debt, the analyst optimism, the market volatility, what does this all mean for someone like you, our listener, who might be thinking about an investment? What's the practical takeaway here?
Well, the strengths are pretty clear. You've got robust revenue growth in a really promising, expanding sector like digital payments. You have strong analyst consensus pointing towards substantial expected upside, and the technicals could be nearing a point where they turn around, especially as the price tests support. However, those positives are undeniably balanced, maybe even outweighed for some, by very significant concerns. Primarily, that extremely high leverage we keep hammering on, those persistently thin net profit margins, and the recent negative technical signal showing short-term weakness. These factors, taken together, definitely elevate the stock's risk profile quite a bit. It tempers conviction for an aggressive buy right now unless you have a very clear understanding of and tolerance for those specific risks.
So it sounds like it's definitely not a straightforward buy or sell for everyone. Given that really complex profile, who is this stock potentially best suited for? Which type of investor should even be looking at priority technology holdings, do you think?
I'd say priority technology holdings is probably best suited for medium to long-term investors who are genuinely risk tolerant. People who specifically want exposure to the high growth potential within the payment technology sector. These would be investors who can stomach significant volatility along the way and who believe in the company's underlying story, their ability to eventually pay down debt and improve profitability over time.
And for short-term traders.
Short-term traders, on the other hand, might want to exercise more caution here. They should probably wait for a clear technical reversal signal or maybe some stabilization in the price given the ongoing volatility and that negative momentum we've seen recently. They'll likely want more concrete signs of a turnaround before jumping in.
Okay. Priority technology holdings really presents a truly fascinating case study, doesn't it? High growth potential tangled up with really significant financial leverage. It perfectly highlights that complex balancing act companies in rapidly expanding sectors often face, where that aggressive expansion can come with a heavy cost of capital and a lot more risk. It's a prime example of a company needing a really thorough look, way beyond just the headlines.
Indeed it is. And this brings up an important question, I think, for you, the listener, to maybe ponder. In this era where tech innovation often demands rapid scaling and huge investment, how do companies in these high-growth, super competitive sectors best balance that aggressive expansion, that drive for market capture, with the crucial need for financial prudence, especially when it comes to managing substantial amounts of debt? It's a tough challenge many promising companies are navigating right now.
That is a great thought to leave everyone with. Thank you so much for joining us on this exploration of Priority Technology Holdings. We really hope this breakdown has given you a clearer, maybe more nuanced picture of this intriguing, complex company. Until next time, happy investing.